Hi everyone, welcome back to another video. I'm Vitri Trong, your trusted mortgage advisor. Today I want to talk about a subject I've seen a lot of people post about, and that's remortgaging in case of a second pandemic and a second economic downturn this fall. Like, how do you protect yourself if this were to happen? Right. So I think most people, if you weren't affected, just keep doing what you're doing and refinance maybe and grab some of those super low rates. But what if you're part of this higher group of high risk people, right? So anyone who may have seen a decrease in their income the first time around and maybe at a larger, higher risk of seeing their income decrease the second time around as well. Or maybe you've got some health issues, and if you got sick, there would be a really good chance it would take you a lot longer to recover. And maybe you don't have any health insurance or disability that would provide income in case of an economic downturn, which we may have this fall. So, there's a lot of stuff about the reconsolidation with low rates, but you gotta keep in mind cash flow during the pandemic. Consolidation is not enough if you're one of these higher risk groups. So let's tackle that this video. So we are going to talk about the right way to restructure your mortgage in case of a second economic downturn with a second wave of the pandemic this fall. Okay, so let's say clients have a $400,000 mortgage, their monthly mortgage payment's $2,115, they got 20 years left. They also have a car loan with 4 years left, a credit card, which they're throwing $300 a month in with 4 years left. They've got some home renos, right? So they took out a loan, did some home renos a few years ago. There's $800 a month on that, and there's 6 years left. Add up all the numbers, it's total debt load of $480,000, and their payment on that is $3,900. And spouse one and spouse two, equal opportunity here in Canada, so they're making exactly the same amount. And you know what? If you add up both of their take-home pay, right? This is after-tax income. Subtract the $3,900. That means they have $3,680 left over to pay for life, right? Gas, groceries, karate, whatever, kids' education. Looks like they're okay. They're doing okay. This is perfectly fine if a pandemic didn't happen, right? So. What I'm seeing a lot out there is these people here, they're being told to refinance into a regular mortgage, and hopefully that'll solve the problem. And let's just see what that looks like. So the old way, $480,000 mortgage, $3,900 payment. The new mortgage, 2.29%, guys. That's what we can refinance a mortgage to today. I know there's rates out there under 2%, but for a refinance where we're adding debt and extending the years, this is a killer rate. All right, so if we did that, we take the monthly payments from $3,900 to $2,539. That's a net savings of $1,361. So this is where a lot of advice stops right here, because for a lot of people, that's good enough, right? You're able to get $1,300 more cash flow per month. You're probably golden. And if you were one of these people who weren't infected at all by the pandemic, you were an essential worker, you kept working, you were doing okay, this is where my advice would stop for you, right? Because, both spouses still working, your new net cash flow to pay for life jump to over $5,000. You're probably further ahead by reconsolidating all that high interest debt into your mortgage now, right? But what if you're at high risk? What if you lose your job? Right? What if you couldn't work, you got ill and you couldn't work and there was no paycheck coming in? What does that look like? So spouse one, their income goes to zero now. What's going to happen to cash flow? Well, that goes down to $1,251. I don't know about you, but that starts to get really, really tight, really uncomfortable to pay for life, right? Especially if you have kids. Kids are expensive, right? So that, I don't know, you might, some things might not get paid every month if that were the case. So, this is where I think a change in advice, if you're at one of those high risk populations. So here's what I would do. I would get a HELOC, home equity line of credit, also known as a Scotia Step or even a Manulife One. It's something like that, basically a line of credit mortgage. Okay, so here's what that looks like. So back to the original example, $480. $3,900 payment. Now, the HELOC rate is 2.95, so it's higher, right? It's still under 3%, but it's higher. And that's because it's interest only, right? It's very, very flexible, and we'll talk about that flexibility in a bit. But if you just make the interest only payment of $11.80 per month, you would have infinite years left. That's right, you would never pay this thing off. But in an emergency, that's okay. We're just concerned about preserving the home, keeping everyone fed, keeping the lights on in an emergency, right? So you can see in this case, the cash flow jumps to $27.20. You've reduced your payments by that much. Let's say spouse one still makes zero, spouse two still makes $37.90. So your net cash flow now to pay for life is $2,600, right? That's a lot better than the $1,200 from the previous example if one spouse lost their income, right? So this is still not great, but it's a lot better. Now, I want to ask you guys, what would happen if the second spouse loses their income, right? So now you got both spouses making goose eggs. What would happen in a regular mortgage? Well, you got about 3 months of that before foreclosure happens because you couldn't make your payments, right? Maybe you rack up the credit cards to make mortgage payments. That's ugly. Don't do that when you can do this. So here's what this HELOC does. So let's say the home value for this client was $970,000. Typical house in Surrey here. Maybe that's a townhouse in Coquitlam, and maybe that's a condo in Vancouver, right? So let's say there we can get them 65% of the value of the house, $630,000. Their income, in my example, does actually fit that as well. So they would income qualify for that much mortgage. We take out the current $480,000 of all of their debts they're currently using. That leaves a net of $150,000. And I like to call that the just in case stuff really hits the fan account, right? That's the money left over in case all that bad stuff does happen. They both have no income coming in. Okay, so what does that look like? A monthly payment. So we talked about the interest only, $11.80. Lights, internet, food and heat, LIFH initials, right? Also says life. Not bad, hey? Came up with that one myself. Let's say that's $3,000. So their total monthly output or spend is $41.80. I know that's a little high, especially if both have lost their job. They're probably cutting back in a lot of areas. But let's go high for now, just to show you what's in the example, okay? So if you took $41.80, divided that into $150,000, and accounted for some compound interest happening, you would have 34 months of payments made by your line of credit. Right? So you could keep going with no income for 34 months. That's almost 3 years. Do I think it would take this couple 3 years to recover? No. Would I advise them to take 3 years? No. You know, after 3 months, 6 months, a year, we're probably revisiting this every quarter just to see, do we sell, do we downsize, do we do something else? But if worse comes to worse and they had to stay there, 34 months, that's pretty good, right? That's something that a regular mortgage will not do for you. So have a look at this. If you have a high risk of losing both incomes, you know, we can't depend on the government to provide more assistance. We just don't know. But here, you can protect yourself. Right, so when life is back to normal, what does the HELOC do? Well, it allows you to aggressively repay that debt super fast because it's 2.95, so it's higher than a regular mortgage, so there's got to be some benefits, and that benefit is the flexibility. You can put as much into this mortgage as you want. There's no penalties for extra payments on this. Right? You can put both paychecks into it if you wanted to. You know, even if you put both paychecks in, you're doing okay. The week after that, maybe your car alternator goes. Right, that's a big repair bill. Now you don't have any savings for that. Go ahead and pull that back out of your line of credit. Totally okay. The HELOC gives you that flexibility to tackle all of life's events that it throws at you. Right, it's readvanceable. Also, here's the kicker. You can lock in a portion of your HELOC into a 5-year fix. You can do a 229 or 239 or something like that, something very comparable inside your HELOC. Right, and as you're if you have no income, the mortgage payment on that 5-year fixed portion comes out of the line of credit piece, right? And because that mortgage payment, half of its principal and half of its interest, it's kind of like a HELOC in itself, right? So we can get in that more detail, but guys, this is how you plan properly for a second wave of the pandemic. Right, guys. So thanks for watching. And that's what I have for you today. If you like this, please hit subscribe. And please head to my website, trustedmortgages.ca, and subscribe to my newsletter, right? And you'd be first to know whenever I write a new article, have a new video, and any community stuff we do in the future. Thanks so much for tuning in.